Mapletree Industrial Trust, or MIT for short, has often been heralded as a gem in the s-REIT market. It's easy to see why. If you had bought the REIT in 2014 at $1.40 per unit, you would have achieved a compounded annual return of 10% if you take into account both capital gains and dividends received. Pretty decent, I would say. With its stellar performance thus far, I want to see if MIT can continue on this upward trend in the future. Thus, I'll be analysing the REIT's first half FY23/24 financial results, its potential tailwinds and headwinds, and finally whether the current market price is trading at an attractive valuation or not. So let's get into it. Based on MIT's first half FY23/24 results, gross revenue and net property income came in at $344.7 million and $259.4 million respectively, representing year-on-year changes of positive 0.4% and negative 0.3% respectively. DPU-wise, it came in at 6.71 cents, which was a 2% year-on-year drop, partly due to an enlarged unit base following the equity fundraising exercise for the recent acquisition of the Osaka data center. Also, keep in mind that a small portion of distributions were bolstered by past divestments. If you look at MIT's past 5-year performance, gross revenue and net property income have increased at a compounded annual growth rate of 16.2% and 15.8% respectively, with DPU increasing at a compounded annual growth rate of 2.8%. In terms of debt management, borrowing costs increased by 20.6% year-on-year to $52.7 million. This figure represented around 20.3% of net property income. With this increase in borrowing costs, interest coverage ratio and adjusted interest coverage ratio fell to 4.6 times and 4.3 times respectively. Despite this, the average debt cost decreased to 3.2%, mainly due to the Japanese yen-denominated loans for the Osaka data center acquisition. The aggregate leverage ratio remained healthy at 37.9%. In terms of tenancy performance, MIT's occupancy rate came in at 93.2%, which was a slight dip from 93.3% recorded in first quarter FY23/24. Nevertheless, rental reversions were positive across all property segments and ranged between 4.7% and 9.9%. On average as a whole, rental reversions were positive at 8.8%. Overall weighted lease expiry also remained rather high at 4.2 years. Overall, I would say that MIT's performance has remained rather resilient given the current interest rate environment. Let's now consider the potential tailwinds and headwinds for MIT. In terms of the industrial property market in Singapore, overall rental rates have increased by 9.3% year-on-year. If you look specifically at the rental index for business parks and factories, we can see there's also been an upward trend since Q3 of 2020. This will most likely result in continued positive rental reversions for MIT. On the occupancy side of things, it remains healthy for all property segments of MIT except for its business park segment. However, this rather low occupancy in comparison for business parks is rather in line with the market occupancy rate trend for business park as a whole across Singapore. With a bulk of industrial spaces coming into the market in 2024, unit holders want to monitor if this causes any adverse impact on MIT's occupancy rates in the future. This is especially important given that MIT's industrial property revenue growth has been rather tepid over the years. As seen, all industrial property segments recorded low single-digit compounded annual growth rates, with light industrial buildings recording negative growth over the past 5 years. This subsequently resulted in a low single-digit compounded annual growth rate for revenue from Singapore, which also included revenue from Singapore data centers. While light industrial buildings only contributed 0.5% of MIT's gross revenue for first half FY23/24, high-tech buildings and business parks do contribute a more considerable percentage of 20.8% and 6.6% respectively to MIT's gross revenue. Despite the rather slow growth in industrial property revenue, MIT does have some green shoots opportunities. For instance, the recently completed high-tech park at Kallang Way should provide an upside to earnings as it gets progressively filled up over the next few months. Currently, as of first half FY23/24, it is at a committed occupancy rate of 48.2%. Also, over the years, MIT has a good track record of creating and returning value to unit holders either through divestments of older properties or asset enhancements and redevelopments of older factory spaces into new high-tech buildings. Let's also not forget the growth opportunities in the data center segment. rental rates in the North American data center market has seen a 7.2% year-on-year increase, mainly driven by limited data center spaces and the current high market demand due to AI and cloud computing. The recent acquisition of the Osaka data center should also provide further upside to MIT's earnings, albeit at an incremental rate as it gets progressively fitted out till May 2025. Additionally, MIT also holds a right of first refusal for 13 North American data centers in the Mapletree Rosewood Data Center Trust, which is a 50-50 joint venture with its sponsor. This could provide future acquisitions and growth opportunities for MIT. With that said, it should be noted that one of MIT's major tenants, AT&T, will be progressively vacating 2 out of 3 of its North American data centers in MIT's portfolio over the next few months, as its lease is up and will not be renewed. This could have a considerable impact on MIT as AT&T currently contributes 5.1% of gross rental income as of September 2023. The slight good news is that MIT is in advanced negotiations with a replacement tenant to take out one of the 2 data centers. With regards to MIT's finance costs, it will most likely increase in the near term, as 21% of total debt, or $644.9 million, will have to be refinanced over the next year and a half. This round of debt refinancing also coincides with the expiry of $150 million worth of interest rate hedges in FY23/24, which will likely result in all-in debt costs to increase moving forward. Even if a rate cut was to happen in mid-2024, as predicted by market consensus, the rate that MIT refinances its debt to will still likely be higher than its initial debt interest rate. As a whole, MIT has opportunities for future growth upside. However, this will still be limited by increased borrowing costs in the near term. Now, on to the question, is it a good time to invest in MIT right now? If you look in terms of net asset valuation, MIT's current PB ratio stands at around 1.2 times based on the market price of $2.27. This is lower than its 5-year historical PB ratio of 1.48 times. However, it should be noted that MIT will be undergoing asset revaluation soon in March 2024. This will likely result in a reduction of portfolio valuation and consequently negatively impact MIT's net asset value, as the benchmark US interest rate has risen since the last valuation in March 2023. In terms of dividend yield, using the DPU for first half FY23/24, and assuming that MIT's performance remains stable, full year FY23/24 DPU would thus be at around 13 cents. This gives MIT a dividend yield of about 5.73%. In comparison, the recent 6-month TB auction closed at a yield of 3.75% per annum, while the highest fixed deposit rate currently in the market sits at 3.5%. Thus, investing in MIT right now gives you a risk premium of about 2 to 2.2%. From a technical analysis standpoint, MIT has recovered slightly from its previous support at the $2.10 region. The next major support level would be at the $1.80 region. To answer the question of whether you should invest in MIT right now, if you ask yourself if a 2 to 2.2% risk premium is acceptable and worth it for you. Personally for me, if I'm interested to invest in MIT, I will most likely buy a small amount at the $2.10 region before investing a bigger amount at the $1.80 region. So when we look at MIT's latest first half FY23/24 results and evaluated its prospects and risks, I am of the view that MIT should continue on its path of a slow and steady growth, at least till its next major acquisition, which could be for more data centers in the US market. Nonetheless, I am still slightly concerned by the performance of its Singapore industrial properties. Thus, potential of current unit holders should definitely monitor this performance in the near term. Are you looking to invest in Mapletree Industrial Trust, or are you already a unit holder? So let me know your thoughts about the REIT in the comments below. As usual, if you found this video helpful, drop a like on it and subscribe to our channel for more finance related content. With that, I will see you all in this video. Goodbye!